What happens? If the US dollar loses its global reserve currency status, imagine waking up tomorrow and finding out the US dollar is no longer the world's money. Oil, priced in yuan, international loans, issued in euros, and your vacation to Paris, suddenly it costs the price of a used car. Today we're diving deep into what would actually happen if the US dollar lost its global reserve currency status. With history, future scenarios, and yes, a few bad jokes. A global reserve currency is the money most of the world's governments and businesses use for big transactions, buying oil, paying debts, and settling trade. Right now, the US dollar is like Beyoncé in the world of money. Everyone wants it, and it's headlining every global tour. But Beyoncé doesn't stay on top forever, and neither does any currency. A reserve currency isn't just about prestige. Central banks stockpile it. Commodities like oil, wheat, and gold are priced in it. Big international loans issued in it. If you're an importer in Brazil buying oil from Saudi Arabia, you probably pay in dollars, even though neither country uses the dollar domestically. That's how deep the dollar's role runs. The US dollar didn't always wear the crown. In the 1600s, the Dutch guilder was the global standard, powered by Amsterdam's vast trade empire. Then came the British pound in the 1800s, backed by the Royal Navy and colonial power. Even the Spanish silver dollar had its run in the 16th and 17th centuries, riding on Spanish treasure fleets. History shows no reserve currency reigns forever. The dollar's big break came after World War II at the Bretton Woods Conference in 1944. World leaders agreed to peg their currencies to the US dollar, which was convertible to gold at $35 an ounce. America held 2/3 of the world's gold reserves, so trust was high. The dollar became the global measuring stick. The dollar is stable, liquid, and accepted everywhere. About 60% of global foreign exchange reserves are in dollars. Over 80% of international trade is invoiced in dollars. It's not just economics, it's trust. Trust in the US economy, in its political stability, and in its ability to pay debts. And yes, the fact that the US military can park an aircraft carrier anywhere helps. Being the world's reserve currency is like having a VIP financial pass. It lets the US borrow at lower interest rates, run bigger deficits without crashing the currency, and import goods more cheaply. But perhaps the most controversial perk is this. It gives Washington enormous leverage to impose economic sanctions that really bite. Because most global transactions flow through the US-controlled financial system. In the Cold War era, sanctions were used sparingly, usually targeting regimes considered a direct security threat, like Cuba in the 1960s or apartheid-era South Africa. But over the past 3 decades, the use of sanctions has grown dramatically, both in frequency and scope. In the 1990s, sanctions targeted Iraq under Saddam Hussein, with sweeping trade restrictions that critics say caused humanitarian harm without changing the regime. In the 2000s, they expanded to countries like Iran, aimed at curbing its nuclear program. By the 2010s and 2020s, sanctions became the go-to foreign policy tool, hitting Russia over Crimea in 2014, Venezuela's government in 2019, and a wide range of individuals and companies linked to corruption, cyber attacks, or simply being politically inconvenient to US interests. What's changed isn't just how often sanctions are used, but how broad and sometimes arbitrary they've become. Sanctions now often target entire sectors of an economy, not just political leaders. They can be imposed unilaterally by executive order, without broad international consensus. And sometimes they're applied for reasons that blur the line between genuine security concerns and geopolitical arm twisting. This expansion has real consequences. For sanctioned countries, it can mean economic collapse, shortages of medicine and food, and deepening poverty. But for the US, the overuse of sanctions carries another risk: eroding trust in the dollar. The more other countries see the dollar-based financial system as a weapon, the more incentive they have to create alternatives and to move away from the dollar entirely. China and Russia, for example, have accelerated efforts to trade in their own currencies or create payment systems outside US control. Even allies in Europe have explored mechanisms to bypass US sanctions when they disagreed with American policy. such as the INSTEX system to keep trading with Iran. Each of these steps chips away at the dollar's dominance. Currencies lose dominance when trust erodes. And trust isn't just about economic fundamentals. It's also about whether the system feels fair and predictable. The growing perception that the US uses its reserve currency status not only to settle global trade, but also to punish political rivals, has created long-term strategic blowback. Now add another problem: political turmoil at home. Confidence in the dollar depends on confidence in the stability and governance of the United States. But in recent years, US politics has been, well, let's just say, lively. The country has faced repeated debt ceiling standoffs where the government comes close to defaulting on its obligations. These episodes create unnecessary panic in global markets, not because the US can't pay its debts, but because Congress might not authorize it in time due to partisan fighting. There's also the growing polarization of American politics. In the past, foreign policy and fiscal stability were areas where parties could find common ground. Today, even those have become battlegrounds. Policy swings dramatically between administrations, leaving allies and investors wondering what US policy will be 2 or 4 years from now. The January 6th attack on the US Capitol in 2021 shocked much of the world, not just as a security breach, but as a symbol of deep political fracture. For countries deciding whether to keep hundreds of billions in US assets, these scenes raise uncomfortable questions about long-term stability. Combine overuse of sanctions abroad with political dysfunction at home, and you have a recipe for countries to start asking, is it wise to keep relying so heavily on the dollar? So what could the future look like? Scenario 1. Gradual decline. The dollar still matters, but shares power with other currencies like the euro, yuan, or a BRICS-backed unit. Scenario 2. Sudden drop. Panic selling of dollars by major economies, US inflation spikes, interest rates soar, and living standards fall sharply. Scenario 3. Digital leap. A blockchain-based currency becomes the global reserve, with no single country in control, changing how trade, lending, and investing work worldwide. For everyday Americans, the impact would be real. Imports get pricier, electronics, coffee, cars, mortgage rates rise, government borrowing costs increase, so taxes or spending cuts follow. On the plus side, US exports become cheaper, boosting manufacturing jobs in certain sectors. Is this happening soon? Probably not. Reserve currency shifts take decades. The dollar still has deep trust, unmatched liquidity, and no single rival. But history says no king reigns forever. For individuals, the best move is diversification. Hold investments in different currencies, own commodities like gold, and avoid taking on too much debt. You don't need to panic, but you do need to prepare. So what happens if the dollar loses its crown? The world won't end overnight, but your wallet will feel it. The dollar may be Beyoncé now, but even Beyoncé shares the stage. If you enjoyed this deep dive, hit like, subscribe, and tell me in the comments, which currency do you think could replace the dollar?